What if I told you the next economic crash is not a matter of if, but when? And what if I told you when it happens? Most people will be completely shocked while a small group quietly sees it coming and positions themselves to win. Sounds extreme. Then let me ask you something. Before the 2008 financial crisis, did people think the entire financial system could collapse? Did millions of homeowners believe they would lose their houses? Did big banks think they could go bankrupt? Of course not. In fact, right before the crash, confidence was at its highest. People believed the economy was strong. Markets were booming. Money was flowing everywhere. Everything looked perfect. Now go even further back to the Great Depression, before the crash of 1929. People were making money like never before. Stocks kept rising. Everyone from experienced investors to everyday citizens was jumping into the market. It felt like a golden age. Until it wasn't, because almost overnight, that confidence turned into fear. Prices collapsed, banks failed, jobs disappeared, and the same system that once created wealth suddenly destroyed it. So here's the uncomfortable truth. Economic crashes don't begin when markets fall. They begin when everything looks safe, when people stop questioning risk, when easy money becomes normal, when everyone believes this time is different. That's when the real danger starts building. But here's what makes this even more interesting. Every crash follows a pattern so consistent that, if you understand it, you can actually see the warning signs long before things fall apart. Yet most people miss it. Why? Because during a boom, logic disappears. People don't want to hear warnings. They don't want to believe anything can go wrong. They just want to ride the wave until it's too late. And when the crash finally hits, it feels sudden, it feels unfair, it feels unpredictable, but in reality, it was building all along, hidden beneath rising prices and growing confidence. So the real question is not just why crashes happen, but why do most people fail to see them coming? And more importantly, what do the few who profit from crashes understand that everyone else ignores? Because once you uncover the truth behind economic crashes, you won't just see the economy differently, you'll start to see the warning signs that others miss, and the opportunities they never even realize exist. Most people think economic crashes are caused by a single dramatic event, a sudden stock market drop, a government mistake, a global crisis. Something big, visible, and immediate. That's the common belief. And honestly, it makes sense, because when you look at the headlines during a crash, it always feels like something just happened. In 2008, people blamed the housing market collapse. During the Great Depression, people blamed the stock market crash. It always looks like there's one clear cause. But here's the problem. That's not how crashes actually work. Those events are not the cause. They are just the trigger. The real cause is something much deeper and much slower. Crashes are built over time. Years of rising prices, years of increasing risk, years of growing confidence that nothing can go wrong. But most people don't see this build-up. Why? Because during that period, everything feels good. The economy is growing, jobs are increasing, investments are making money, and that creates a dangerous illusion that the system is stable. Let's break this down in a simple way. Imagine a market where prices keep going up. At first, it's driven by real value. Businesses are growing, profits are improving, and everything makes sense. But then something changes. People stop investing based on value and start investing based on momentum. They buy not because something is worth it, but because they believe they can sell it later at a higher price. This is where the problem begins. Now add another layer. Easy access to money. Banks start lending more. Interest rates are low. Borrowing becomes normal. So instead of investing only what they have, people start investing money they don't even own. This is called leverage, and it's one of the most dangerous forces in any financial system, because leverage doesn't just increase profits, it magnifies risk. But during the boom phase, no one talks about that. Instead, people see others getting rich and think, if I don't do this, I'll fall behind. This fear of missing out pushes even more people into the market. Prices rise faster, confidence grows stronger, risk becomes invisible. Until one small thing changes. Maybe interest rates rise, maybe a few investors start selling, maybe confidence simply weakens, and suddenly, the entire system begins to shake. Because it was never as strong as it looked. And When it finally breaks, it feels like everything collapsed overnight. But in reality, the crash didn't start that day. It started years earlier, when everyone stopped paying attention to the risk. To truly understand economic crashes, you need to understand one powerful idea. Crashes are part of a cycle, not a random event. Not a one-time disaster, but a repeating pattern driven by human behavior. This pattern is often called the boom and bust cycle. And once you see it, you'll start noticing it everywhere. It begins with the first stage, the boom. This is when everything starts to grow. Businesses expand, jobs increase, incomes rise. The economy feels strong and full of opportunity. People become optimistic. Investors start putting money into markets. Stocks go up. Real estate prices rise. Everything feels like it's moving in the right direction. And at this stage, it usually is. The growth is real. But then comes the second stage, easy money. To support growth, interest rates are often kept low. Banks are more willing to lend. Credit becomes easy to access. Now more people can borrow money to invest. This accelerates everything, because instead of using only their savings, people start using borrowed money to increase their investments. At first, this seems like a smart move, because as long as prices keep rising, everyone is making money. Which leads to the third stage, the bubble. This is where things start to disconnect from reality. Prices no longer reflect true value. Instead, they reflect expectation. People stop asking, is this worth it? And start asking, how much higher can it go? This is pure speculation. And it spreads fast. More buyers enter the market. Prices rise even faster. Confidence turns into overconfidence. Then comes the most dangerous phase, leverage overload. At this point, borrowing is everywhere. Investors, businesses, even everyday people are using debt to maximize returns. And this creates a fragile system, because now, even a small drop in prices can trigger big losses, and that leads to the next stage, the crash. Something changes. It might be rising interest rates, it might be slowing growth, or it might just be a shift in confidence. But once prices stop rising, the entire system starts to reverse. Investors begin to sell. Those with borrowed money are forced to sell. And this creates a chain reaction. Prices fall. More people panic. More selling happens. Fear spreads faster than greed ever did. And within a short time, the bubble collapses. Finally, we reach the last stage, the reset. Markets stabilize. Weak investors are wiped out. Stronger players step in. Prices return closer to real value. And slowly, the cycle begins again. This is the truth most people miss. Crashes are not just about numbers. They are about psychology. Greed during the rise, fear during the fall, and the constant human tendency to believe this time is different, but it never is. Let's take a real-world example that perfectly shows how economic crashes actually happen. The 2008 financial crisis. Now, most people think this crisis started when the housing market collapsed, but by now, you already know, that wasn't the beginning. That was the breaking point. The real story started years earlier. In the early 2000s, the U.S. housing market was booming. Home prices were rising steadily. Buying a house felt like the safest investment you could make. People believed one simple idea: housing prices will always go up. And once that belief took hold, everything changed. Banks started giving out loans more easily. At first, they were cautious, but as competition increased, they began lowering their standards. Soon, even people with low income or poor credit could get loans. These were known as subprime mortgages. Now here's where things got even more complex. Banks didn't just keep these loans, they bundled thousands of mortgages together and turned them into financial products that could be sold to investors. This meant the risk didn't stay with the banks. It spread across the entire financial system. At the same time, investors saw these products as safe. After all, they were backed by real estate. And real estate, according to popular belief, never goes down. So demand exploded. More loans were created, more houses were bought, prices kept rising, and just like we discussed, boom, easy money, bubble, leverage. Everything was in place. Then came the turning point. Interest rates started to rise. Monthly payments increased. And suddenly, many homeowners couldn't afford their loans anymore. Defaults began to rise. At first, it seemed manageable. But then housing prices stopped increasing, and that changed everything. Because once prices stopped going up, the entire system lost its foundation. People could no longer sell their homes for profit. Investors started realizing the risk. Panic began to spread. And then, the collapse. Financial institutions faced massive losses. One of the biggest shocks came when Lehman Brothers filed for bankruptcy. This wasn't just any company. It was a major investment bank. And its failure sent a signal across the world. The system was breaking. Markets crashed globally. Banks stopped trusting each other. Credit froze. Millions of people lost their homes and jobs. But here's the part most people don't talk about. While the majority was losing money, a few investors were making fortunes. One of the most famous examples is Michael Burry. While everyone else believed the housing market was safe, he saw the underlying risk. He analyzed the data. He understood the system. And he made a bold decision. He bet against the housing market. At the time, people thought he was crazy, but when the crash happened, he made billions. This is the difference between following the crowd and understanding the system beneath it. So after everything we've broken down, what is the real lesson behind economic crashes? It's not just about markets. It's not just about banks or governments. It's about human behavior repeating itself over and over again. That is the core truth. Every major crash in history, including the 2008 financial crisis and even the Great Depression, didn't happen because the system suddenly became broken. They happened because the system slowly became imbalanced and people didn't notice, or didn't want to notice. That's the first lesson. Crashes are built during good times, not bad times. When everything feels safe, that's usually when the biggest risks are forming underneath. When prices are rising, people stop questioning why. When money is easy, people stop asking where the risk is. When everyone is confident, caution disappears. And that's exactly when the system becomes fragile. Second lesson. Most people lose money because they follow emotion, not structure. During booms, emotion looks like confidence and excitement. People see others making money and feel pressured to join. During crashes, emotion turns into fear. People panic, sell too early, and lock in losses. In both cases, decisions are driven by emotion instead of understanding. And that is why the majority always ends up on the losing side of cycles. Third lesson. Leverage is powerful, but dangerous. Borrowed money can make you look smart during rising markets. But when things reverse, it destroys wealth faster than anything else. This is why so many individuals, companies, and even banks collapse during crashes. They were not just invested, they were overexposed. And finally, crashes are not only risks, they are also resets. After every major collapse, weak systems get cleared out. Overpriced assets return closer to reality. New opportunities appear for those who still have capital and patience. This is why some of the greatest fortunes in history were built after crashes, not before them. Because while most people focus on surviving the fall, a smaller group prepares for what comes next. So the real takeaway is simple. Economic crashes are not mysteries. They are patterns driven by greed, fear, and repeated financial behavior. Once you understand that, you stop seeing crashes as unpredictable disasters and start seeing them as cycles that can be studied, understood, and prepared for. And that understanding alone can completely change how you see money, investing, and the economy itself. So now you know the truth about economic crashes. They are not random. They are not pure chaos. And they are definitely not impossible to understand. They are cycles driven by human behavior, repeated again and again across history. And the biggest difference between people who lose during crashes and people who survive or even benefit from them is awareness. Because when you understand how these cycles work, you stop reacting emotionally to headlines, you stop following hype blindly, and you start seeing patterns that most people completely miss. That's where real financial thinking begins. If you want to go deeper into how money actually moves in the real world, how wealth is created, lost, and transferred during these cycles, then make sure you stay tuned to the Geeky Investor, because here, we don't just talk about what happens in the economy, we break down why it happens. So you can think smarter, plan better, and stay ahead of the system instead of getting caught in it.